Hello, with me today I have Sam Wahab, oil and gas research analyst at Peel Hunt. Hi Sam, thanks very much for joining me today.
Pleasure, Lee. Thanks for having me.
I just want to quickly go through what's happened to the price of oil this year and why. After trading at around $90 in the spring, the price has settled into the high 60s, low 70s. How did we get here, given there are all sorts of geopolitical issues potentially affecting supply?
Yeah, you're absolutely right. It has been a very volatile year to date for the oil price in particular. There's two key areas that are really weighing down on the oil price. The first being very weak Chinese demand. That's one of the engine rooms of the global energy mix alongside the US. And the second is that there's a structural oversupply within the market. Taking the Chinese softening within their demand structure, I mean, it's quite clear when you look at their manufacturing data that it's in decline. It's been very difficult for them, and that's led to a direct impact on the oil price. And then secondly, on a structural oversupply, I mean, if you look back at, you've mentioned geopolitical tensions, again, they have not stymied that issue in terms of that decline. But then if you look at maintenance in Norway and Kazakhstan, issues in Libya, they also haven't created that speed bump for the oil price. And again, that's because OPEC are pumping more. Then you see non-OPEC members like Guyana and Brazil. They're also feeding into the energy mix. And therefore, that structural oversupply is really weighing on the oil price. If you consider OPEC, for example, they've got an oversupply capacity of about 5 million barrels per day at the minute. And then if you see them unwounding 2.2 million, there is that gap that will continue to feed into the oil price, not just to the end of this year, but also into next.
So that could potentially keep a cap on the...
Absolutely, yeah.
And you're talking about next year. I mean, what's your view of the next 12 months? How do you think things are going to go in 25? What if there is a ceasefire or a resolution in Ukraine, as Donald Trump has promised us? And if there's some kind of wider peace deal in the Middle East?
Yeah, it's a good question, and very good timing as well, because Peel Hunt just issued their first quarter of next year oil price outlook. We're cutting that $10 a barrel from 80 to 70. I think that's roughly in line with the wider market. City, I think, have gone as low as 60, which is fairly aggressive. But look, the overall, as I mentioned, the structural oversupply, I think, will continue to feed into next year. Trump saying drill baby drill is probably not going to do anything for the oil price dynamic. I think tariffs will be a big issue, and as I mentioned, with the weakening of the Chinese manufacturing data, if they increase tariffs, notably on China, that's only going to hurt it a little bit more. We don't see that happening until possibly Q4 of 25. But in terms of the geopolitical tensions, if there is a resolution, especially within the Israel conflict, I don't really see that having a major impact. I think we've seen intimations recently over the last couple of weeks of there being ceasefire deals. And then going over to Russia and Ukraine, that's mainly a gas dynamic. But even if there were to be a resolution there, I think the sanctions already being in place, it will take years and years for that to unwind. And I don't think the resolution that Trump has in his mind is probably going to be market acceptable in terms of ensuring that there's that energy mix going forward.
Yeah, well, I mean, you've mentioned Donald Trump, you've mentioned drill baby drill, that pledge. So when he takes up his presidency in January, but do you think we will see a big uptick in oil and gas production, and how are energy prices factoring that in currently?
Well, I don't think you'll see a massive uptick. I don't think a 4-year term, regardless of administration, whether it's Republican or Democrats, can really have a direct influence within that time frame. I mean, indeed, if you look at the Biden administration, they're very big on climate change and putting in the Inflation Reduction Act to stimulate that area of the energy mix. But yet, the fossil fuel production hit record highs during their administration. And that's partly a function of the sort of a post-COVID bounce in terms of activity. But it also demonstrates that regardless of who's in office, it's already in place on how you generate the energy within the country. In terms of what Trump can do, there are several factors. I mentioned the tariffs, particularly on the Chinese, which I think will dampen the oil price. But conversely, on the gas price scenario, I think that would be very positive for them. And he's not going to do that through increasing the drilling activity and production, but through LNG exports. So at the moment, they have around 13.8 billion cubic feet of export capacity. That's set to ramp up by 28 BCF by 2028. Now, even if they miss that target, it's going to be a huge draw on domestic gas production, and the prices commensurate with that. They can't stay as subdued as they already have. Then that will feed into free cash flows of the underlying independent companies, producing that gas. So I do think there's going to be a bit of a conversion there. Oil price, I think, will be weak compared to where it is today, but I think US nat gas prices will improve over the Trump administration term.
Okay. Sam Wahab, oil and gas research analyst at Peel Hunt. Thank you very much for joining me today.
Thanks for having me.